Last week, we talked about September real estate market numbers for the Huntsville, Alabama market. This week, let's talk about some consumer trends and some other real estate trends that might affect 2024 in terms of real estate values and our home sales in our area. All right, so first let's jump into consumer spending. Consumer spending in this country is really one of the key drivers to inflation right now. It could make a big impact on our economy in 2024 as our savings rate has basically been cut in half since 2019. It's down to 3.4%. And what's driving this is this experience economy. A lot of people are seeing inflation numbers continue to rise, and so they feel like they're losing the value of their money, and so they're starting to spend it. And Delta's seeing a 30% jump in earnings in Q3, and then also Ticketmaster's up 18% year over year, which is really simply unsustainable. So I want to focus on two groups. The Wall Street Journal focused on this one group that is experiencing this in kind of a positive way. They feel like they're in a good position in terms of low mortgage rates. Their mortgage rate may be locked in the high 2s or low 3s. They have a stable job, and so they're able to cover that mortgage easily. And also they're seeing these rising home values as kind of this wealth effect, and so they're apt to spend more money. The challenge is they're not saving as much money as they once were. And this potential wealth effect of their rising home value is really untappable right now. As we have higher interest rates in the 8% range, we're really not in a position to refinance and really do that cash out refinance to be able to tap into that equity. And so it's really paper money for this group right now, and their savings rate has dwindled down. And so for this group, what I would recommend, since you're feeling that pinch on the inflation in terms of your value of your money disappearing, I recommend, if you already have a home, recommend looking at investment properties right now, as there's a lot of new construction and other property on sale right now where you can get in at a really good price. Or second, look at other physical assets, other than US dollars to invest that money, because this experienced economy jobs are really what's propping up the economy. And as those experienced economy jobs start to slow down, that's where we're going to potentially see a recession in this country with potentially job losses. And that's where you're going to want to store up your kind of your rainy day funds for the future. So the second group was the group that I want to talk about the most. It's actually the group that wasn't even included in this Wall Street Journal article, but it's a group that is really at risk in this economy. They're not feeling the wealth effect by rising home values. They're actually experiencing it the other way, where affordability continues to decline because we have higher mortgage rates, higher prices, and inflation is hitting them hard. And so, however, they are continuing to spend money on these experiences. Experiences are great, but we've got to look at a long-term picture with this group, 1 year, 3 years, 5 years down the line. And so my recommendation to this group is reinvest the money that you would be spending on these experiences into saving up for a home. And if you don't know how you could save up or even potentially purchase a home in this market, we're happy to sit down with you and advise you and come up with a plan to get you in a home and start building wealth and stability for you and your family. So really the takeaway for both of these groups is our saving rate in this country is dangerously low. So let's get that savings rate back to where it needs to be, because we may need that for a rainy day as a potential recession comes, and reinvest that savings back into hard assets, especially real estate, either on the investment side or buying your first home. Another key headline that could play a big factor in 2024 is that mortgage applications are down to a 28-year low. They're down 6% week over week, and they're down 21% year over year. And the reason that's important is real estate and the mortgage industry drive so much of our economy. And so as mortgage applications are down, we're going to need fewer loan officers. We're also going to need, fewer team members at banks, and there's already being announced layoffs at banks, layoffs at mortgage companies, which is also going to filter over into the real estate industry. There's real estate agents getting out of the marketplace, and then contractors that rely on real estate business will continue to get out of the business. And so that's going to help drive down, unfortunately, GDP and potentially put us into a recession in 2024. And what's really driving this is not only the Fed raising interest rates, but they haven't done that since July. And so the factor behind higher interest rates and lower mortgage applications, not that there's not demand out there, it's just simply that the demand has dampered down with the lower interest rates. And so if we have lower interest rates, there's plenty of demand in the marketplace that's just sitting on the sidelines. But what's really driving up those interest rates right now is the higher 10-year treasury rates. And 10-year treasury rates are increasing right now because there's a couple of things. One is the Treasury Department is just issuing more debt than most of the market really anticipated. So we have a supply and demand imbalance in terms of the debt in this country. And Japan is also changing some of their incentives in terms of buying their debt. And so potentially some of the potential demand that we would have for US debt is going over to Japan debt right now. And so that's a big concern looking forward. We are simply not physically sound in our country right now. We're spending more money than we're earning. And so we're having to continue to issue more and more debt. And the question is, will we physically get sound? And if not, is there going to be enough demand for those notes that are being issued by the Treasury Department? And if there's not, expect to see higher mortgage rates for a much longer period of time. And we may even see higher interest rates as well, which will affect both our GDP and the overall economy in 2024. The last thing I want to talk about is commercial real estate in this country. Commercial real estate is going to continue to have an owner, but those owners are probably going to change according to Warren Buffett. He's predicting that commercial real estate values are going to drop somewhere between 25 to 30%. He thinks we're about halfway there. We've probably got another couple of years of this. Basically, the data out there shows that 1 in 5 office buildings are coming due in terms of their interest rates by 2026. And the reason that's important is commercial real estate operates differently in terms of financing than residential real estate. Most of these commercial notes are on a balloon note, typically a 5-year, 7-year type balloon, whereas residential real estate is typically fixed for 15 or 30 years. And so what happens on these commercial loans is when they come renewable, then you have to basically renew at a higher interest rate or renew at the current interest rates, whatever they are, whether they're lower or higher. And obviously these rates are much higher than they've been. And so it's a perfect storm for the commercial real estate industry as vacancy rates are down. You even have Dropbox paid $79 million recently to get out of a lease of 165,000 square feet in San Francisco. So you have these huge office buildings that are sitting empty, and then the interest rates more than doubling on the landlords. And then the third factor that comes into play as well, basically these loans are set up typically on what's called a debt service coverage ratio. And so it's based on how much money the property brings in versus how much the mortgage costs. And so as the mortgage comes up and less income coming in, that throws the debt service coverage ratio all out of whack. And basically that means the owner not only has to pay a higher mortgage rate, but they also typically have to cash inject. And so with that, a lot of these commercial office builders owners are going to have to turn the keys back into the banks. And how does that affect you? Well, that is going to slow down lending in this country. We've already talked about lending applications being down, but a lot of these local banks that lend to commercial products, they're not going to have the lending opportunity on residential because they're going to have so much of their equity tied up in these commercial deals and these foreclosures. And so this is something to really look at going forward. And then also, how does our country readjust this commercial space, because there will be a new owner of it. How can we repurpose these buildings that office workers are simply not going to now? So these are 3 trends that can affect us going into 2024. There's a lot of other trends that are going to affect the 2024 real estate market, especially here in the Huntsville area. We're going to talk about those in the coming weeks and come up with our predictions for 2024, so stay tuned.